Preferred securities are the top performing fixed income category in 2024, and they continue to offer the highest yields among investment grade securities, income that is often tax advantaged for U.S. investors. Today, we'll look at recent developments that we believe are favorable for investors from both a short and long-term perspective. New issuance in the preferred securities market this year is on pace to surpass its trailing 5-year average. Yet the technical backdrop for preferreds is quite positive, in our opinion, for several reasons. While preferred new issuance has risen sharply in 2024, many of the deals coming to market are replacing securities that are being redeemed, resulting in limited net new supply. In fact, the size of the exchange-traded $25 par portion of the preferred market has shrunk as a result of net redemptions. This is in contrast to other areas of fixed income, where net new supply has grown this year. Bank preferred refinancing activity has been notably strong this year. Taking advantage of current tight credit spreads, European banks have increasingly tendered securities that are callable in the near term, while U.S. banks have refinanced or redeemed higher cost preferreds, some of them being floating rate. A large portion of the new issuance is driven by a recent change in the methodology used by ratings agency Moody's. As a result of the change, corporations are issuing hybrid securities as a tax-efficient strategy to obtain equity credit. This has spurred utilities, with many being new to the preferred market, to issue hybrids. In some cases, utilities replace previously issued perpetual securities with new hybrid securities. Hybrids are long-term junior subordinated deferrable debt securities with set maturities that pay interest income, in contrast to perpetual securities that pay dividend income and are therefore less tax efficient for the issuer. Most of the new hybrids are investment grade and come with attractive yields in the 6.5% to 7% range. In many cases, they're also being issued with favorable structures that partially lose equity credit after 10 years, at which time they're likely to be called since, after that, they would be considered higher cost debt funding. Since these new issues effectively remove extension risk after 10 years, investors are finding that the structure and higher yields offer the potential for attractive risk-adjusted returns. Coming from a stable non-financial sector, they also provide greater diversification. Longer term, we believe Moody's methodology change will lead to a greater level of gross issuance from non-financial companies. Bank and insurance issues currently comprise roughly 70% of the preferreds market. So a broadening of the market could increase the diversification potential of preferreds in fixed income portfolios.